Most Forex traders don't fail because they're lazy or unintelligent. They fail because they're trying to solve the wrong problem. They believe the key to success is finding the perfect entry, the perfect indicator, or the perfect strategy, when in reality, professional traders are focused on something completely different. And the uncomfortable truth is that most traders are working incredibly hard at approaches that were never designed to produce consistent results in the first place. But once you understand why traders actually fail, the path to trading professionally becomes much clearer. This is where it gets interesting, because if you look at the statistics, the majority of Forex traders lose money over time. And it's easy to assume that's because trading is impossible or unpredictable. But the real reason is much simpler. Most traders approach Forex as a short-term prediction game, while professionals approach it as a structured decision-making process based on macroeconomic forces. The typical retail journey usually begins the same way. A trader opens a chart and starts learning technical analysis, support and resistance levels, trend lines, indicators, oscillators, moving averages. Strategies promise high win rates and quick profits. For a while, it can feel like progress. Trades work, confidence builds, it feels like you're getting closer to consistency, but then something changes. The same strategy stops working. Breakouts fail, trends reverse unexpectedly, signals appear reliable one month and unreliable the next. Losses start to accumulate, frustration grows, the trader begins searching for a better system, a better indicator, a better time frame, and this cycle can continue for years, and this is the part most traders never fully recognize. The problem isn't discipline, the problem isn't psychology. The problem is the lack of a framework that explains why markets move. Indicators measure price. They do not explain price. They describe what has already happened, but they don't tell you what forces are likely to push the market next. Without understanding those forces, trading becomes reactive instead of structured. Professional traders think differently. They start with the drivers of the market rather than the chart. They want to know which economies are strengthening and which are weakening. They want to know where interest rates are likely to move. They want to know how global risk conditions are evolving. These forces shape currency trends over time, and this changes everything, because when macro conditions support a currency, price movements begin to make more sense. Pullbacks look different, volatility looks different. Instead of feeling random, movements start to look like part of a larger structure. One of the biggest mistakes traders make is overtrading. When you're focused purely on charts, there always seems to be another opportunity, another setup, another signal, but professional traders understand that high probability opportunities appear when macro conditions align. They are selective, they wait for conditions that support their view. This patience creates consistency. It's not about trading more, it's about trading better. Another major difference is time horizon. Retail traders often think in terms of hours or days. Professionals often think in terms of weeks or months. Macro forces evolve gradually. Interest rate cycles unfold slowly. Growth trends develop over time. Positioning alongside these forces allows traders to benefit from sustained moves rather than short-term fluctuations. And this is why many traders feel like the market is constantly stopping them out. They are trading short-term noise inside longer-term trends they do not fully understand. Without macro context, it is difficult to distinguish between temporary pullbacks and genuine trend reversals. This leads to another common mistake: randomness in decision making. Many traders take trades based on isolated signals without a broader framework. Each trade becomes an independent guess rather than part of a structured process. Over time, inconsistency becomes inevitable. Professional traders aim for consistency of process rather than perfection of outcomes. They understand that not every trade will work. What matters is that decisions are based on a logical framework grounded in real market drivers. This is where macro trading provides a major advantage. Instead of guessing direction from price patterns alone, traders analyze the forces driving currencies, interest rate expectations, economic growth, inflation trends, global risk conditions. These factors influence capital flows, and capital flows drive currency movements. Once traders begin thinking in these terms, Forex becomes less mysterious. Trends have explanations, moves have context, decisions feel grounded rather than speculative, and this shift often creates a major turning point. Traders stop searching endlessly for the perfect strategy and start building a structured approach to the market. They begin focusing on understanding rather than prediction. This is exactly the kind of structured framework we built MacroDrivers to provide. Instead of trying to assemble macro information from dozens of different sources, the platform tracks the major forces that drive currencies. Currency strength across economies, changes in macro trends, shifts in global risk conditions. The information is organized in a way that reflects how professional traders analyze markets. What's interesting is that traders who adopt a macro framework often find that their psychology improves naturally. When you understand why you're in a trade, it becomes easier to hold positions through normal volatility. Decisions feel more deliberate. Confidence becomes more stable. Technical analysis still has a role, but its purpose becomes clearer. Charts help with timing and risk management. The macro framework provides direction. This combination allows traders to operate with structure rather than guesswork. And once you understand the difference between amateur and professional approaches, it becomes clear why so many traders struggle. It's not because Forex is impossible, it's because most traders are never taught how currencies actually move. Professional trading is not about predicting every move or avoiding losses completely. It's about aligning decisions with the forces that drive markets and managing risk within that framework. If you're serious about improving as a trader, understanding macro is one of the most important steps you can take. That's exactly why MacroDrivers exists, to track currency strength, macro trends, and global risk conditions in a structured way that reflects how professional traders approach Forex. Because once you move beyond random trading and start operating with a professional framework, Forex stops feeling like a guessing game and starts feeling like a process you can refine over time. And that's the real difference between traders who struggle and traders who eventually succeed.